my co-anchor over there already introduced you. And Valentin, thank you so much for coming on the short notice, actually.
My pleasure.
Very well appreciated. But how come the markets are not appreciating this bad negative number? Because, you know, bad number is good, supposed to be good for the stock market. And these non-farm payrolls didn't come so good. Was that a surprise to you?
You see, I don't really look at these things in the short term too much because you have to consider the long-term picture more than the short term. So I don't look at the surprises, etc. But, of course, other people do. And there are different people interpreting things differently. So you probably had a few people in the morning selling off when they saw those shocking numbers, 142,000 rather than the 201 expected, lower than the lowest estimates of 149,000.
Right.
So they press the sell button, they sell the stock, market drops about 1%, right? But then you probably have some people saying, wait a second, Fed looks at inflation, there is no inflation, hourly wages are flat, the weekly wages are down, unemployment rate still at around 5.1%. So the Fed doesn't have reason to raise rates and might even do some easing. So they press the buy button, and now the market turns around and is roughly
It will
flat.
turn around, you're saying.
Well, no, it already turned around.
It
It's
already
flat.
did.
Yeah,
Oh,
it's
okay.
flat now. It's flat.
Well, it's flat. That's true. It was really in the red, and now it's flat. I think they're digesting.
Right.
So how about Fed? How is Fed going to digest these numbers? What is your outlook? Yesterday, the traders said 43% chance that the rates are going to be increased in December. Do you believe in that? Do you buy that? What do you think? And all the Fed officials are talking, Valentin. They are saying that, oh, the economy is fine and strong. We should raise interest in 2015. What do you say about that?
Well, the Fed really, at this point in time, all they have left is talking. And
I like that.
I mean, yeah, that's what they said. We're going to raise rates in 2015, in early 2015, and mid 2015, then September. Now it's going to be December. I mean, I'm sorry, if you just keep talking and never do it, at one point you just lose all your credibility. But in reality, this report just underlines the fact, again, that you have the employment situation roughly stable. It's not great because we spoke about the long-term issues about the low number of people in the labor force. So that's why you have low unemployment rate, but actually you have roughly 40% of the population which is not even participating. And then you have the bad numbers now. So the Fed really doesn't have any reason to raise rates. There's no inflation. And then you have a really big problem on the other side, which is China, and the Fed mentioned China.
I was going to come to that, yeah, because yesterday there was such a big report about, you know, now we're looking into the data-dependent Fed and the global economy's outlook, and it's slowing down. But China had some numbers that came better. So there's a stabilization, they are saying, not too much deterioration. Is that correct?
So I would say flat out, no stabilization. The China thing is really out of control. But let's have a look at first of what the Fed is looking at, not only short-term rates, but also long-term rates. And China, and this is fairly counterintuitive, but they can influence the long-term United States rates by selling off treasuries. You know, they have about 1.2, 1.3 trillion in treasuries, and they have already sold roughly 400 billion over the course of the year. And now in August they have sold 120. In September they might sell another 100 billion. So for every 500 billion of treasuries they sell, and all other things equal, you will have a 1% rise in long-term US interest rates. And that's, given how low they have been and how still sluggish the economy here is, that's something the Fed cannot really tolerate. Now, so that's the Fed considering China is having problems. So, for example, the stabilization, you don't see the stabilization in the drain on the foreign exchange reserves. Why are they selling their reserves? Because they want to keep the exchange rate stable while capital is moving out of the country. Everybody that used to think China was a great place to invest is now pulling money out. Why? Because there are no returns there anymore. You invest in Chinese real estate, you lose money. You invest in the Chinese stock market, you lose money. You invest in a Chinese corporate bond at 10%. Now that they're actually allowing defaults, you're going to lose money. You thought the exchange rate you don't have any risk. Well, guess what? With the devaluation in August, now you have risk. So you're moving your money out. That's why they have to sell the reserves, and that's why U.S. rates might go up because of China. And none of these fundamental drivers, the real estate market, the stock market, the excess capacity, none of that is changing. Yeah, you might have some indexes going up a bit, like services are doing pretty well, for example. But overall, the picture in the Chinese economy is really not good, and the trend has now shifted from accumulating reserves and exporting and drawing in capital to capital outflows, having to defend your exchange rate, and basically all the asset markets impaired. And this is not going to change in the near future, if in the next 5 years or 10 years.
5 years or 10 years. Nobody talks about, explains the Chinese economy better than you. And I remember you telling me, you said that nobody really understands the Chinese economy, right?
Most people don't.
Most people don't. But this is a great insight into Chinese economy and the correlation and its impact on the U.S. economy. Talking about the U.S. economy, though, we also have the earnings ahead of us. Yes, the dollar has been rising. The oil price has been going down. Even the third quarter is like 28% down, I think, the oil. And that impacted the economy, and it's going to impact earnings. The estimates, the outlooks are like down 3%, I think. Can we rely on the earnings a little bit at least?
But the earnings are funny because the absolute number really doesn't matter much. All that matters is the expectations. I think earnings already topped out a couple of years ago, but every quarter the analysts manage to reduce the expectations lower and lower, so a number of companies end up beating the expectations. And in the short term, that leads to a positive market effect. Again, looking at the real underlying picture and bringing China again into the equation, where, of course, for US companies, China is not the biggest market, et cetera, but if you look at the knock-on effects that China has on all the commodity exporters, Australia is slowing down, Canada is slowing down, Brazil is going down the absolute abyss.
That's right.
Russia is crashing.
Okay.
So you add the whole picture and you see that the earnings really for American companies operating globally cannot be too good.
Thank you so much. Sorry, we have to cut it here. I have so many more questions to you, Valentin. Valentin, you have to come back, okay?
Thanks,
My
Monica.
producer is telling me we are out of time. Thank you so much for coming.